China has just unleashed its most aggressive economic stimulus since the pandemic, with a 140 billion liquidity injection and sweeping reforms. This isn't just about saving its own economy. It's a move with massive ripple effects. Global markets from stocks to cryptocurrencies are feeling the tremors. But what does this mean for you, the investor? Stick around as we unpack how China's actions are shaping the future of global trade, market prices, and even Bitcoin. Before we dive deeper, don't forget to hit the like button and share this video if you find it insightful. Your support helps us bring you more critical analysis on the global economy. China has been struggling post-pandemic with several sectors, particularly real estate, dragging down its economic recovery. You might have heard of giants like Evergrande, who crumbled under enormous debt, leaving countless unfinished properties and shaking consumer confidence. But it's not just real estate. Deflation, a silent killer of economic growth, has started to creep into China's economy. Contrary to popular belief, falling prices are not always good. In this case, deflation discouraged consumer spending and slashed company profits. With growth stalling and the risk of recession looming, China had to act. So what has China done? They have rolled out an aggressive stimulus package aimed at stabilizing the economy and restoring growth. China's central bank slashed reserve requirements for banks, freeing up around 1 trillion yuan, roughly $140 billion. This influx of liquidity means more loans for businesses and households, driving economic activity. They have also reduced the reserve repo rate, cutting borrowing costs across the economy. This is great news for homeowners, as the lower interest rates on mortgages will save millions of households, billions in total. The People's Bank of China didn't stop there. They injected over $110 billion into the stock market, giving institutional investors the liquidity to buy more shares, further stabilizing stock prices. Now let's talk about what this means for global markets, particularly for US and international investors. Historically, large-scale economic stimuli tend to lift asset prices worldwide. We are already seeing companies with exposure to China benefit from this. ExxonMobil, for example, saw a 4% uptick within days of the stimulus announcement. Even the mining giant Freeport-McMoRan recorded a stunning 133% rise. As Chinese companies benefit from this injection of liquidity, dividend-paying firms could pass these gains to shareholders. For those invested in dividend stocks, this could mean an attractive period of higher payouts. An interesting angle here is how China's stimulus might impact cryptocurrencies, particularly Bitcoin. When a government floods its economy with liquidity, the risk of fiat devaluation increases. This creates a favorable environment for Bitcoin, which is viewed as a hedge against inflation. And we are already seeing the effects. Bitcoin prices have been climbing steadily, particularly thanks to China's actions. Additionally, China's crypto market thrives in OTC and P2P trading spaces due to restrictions on mainstream exchanges. The continued influx of liquidity could fuel further demand for digital currencies, driving crypto prices even higher. Are you keeping an eye on how these shifts could affect your investment? Let me know in the comments if you think Bitcoin will continue its climb. Looking back, there is a clear pattern between major economic interventions and global market boosts. In 2012, the Eurozone's economic policies drove the US stock market up by 13.5%. Japan's fiscal expansion in 2013 resulted in the S&P 500 soaring by nearly 30%. These historical examples suggest that China's current stimulus could produce similar global market benefits, from surging asset prices to better returns for investors worldwide. However, not everything is smooth sailing. While China's stimulus package has delivered short-term gains, deeper structural issues remain unresolved. For instance, weak domestic consumption continues to dampen growth. Though interest rates have been cut, the public isn't spending as much due to persisting concerns about the real estate market. Additionally, the youth unemployment rate has soared to nearly 19%, posing a major challenge for long-term recovery. To address these issues, China may need to go beyond monetary stimulus and implement more robust fiscal policies. There are already rumors of a possible issuance of sovereign bonds worth over $280 billion to fund further infrastructure projects and boost consumer confidence. If this happens, the global market could see even more upward momentum. So where does this leave us? Investors should watch closely as China's stimulus unfolds. More economic intervention is expected, possibly over the next 6 to 12 months. This could offer profitable opportunities for those with exposure to global stocks, dividend-paying companies, and even Bitcoin. For investors, a dollar-cost averaging strategy in diversified portfolios like the S&P 500 might be ideal, along with reinvesting dividends and considering cryptocurrencies as a hedge against inflation. China's economic stimulus is more than a domestic recovery plan. It's a move with far-reaching consequences for the entire global economy. From stocks and commodities to cryptocurrencies, these measures could significantly alter the investment landscape. As always, stay informed and adaptable to capitalize on the shifting tides of global finance. If you found this breakdown helpful, be sure to like, subscribe, and ring the notification bell so you don't miss any updates on global economic trends. Catch you in the next video. Thanks for watching.